Hi, everyone. This is Matt Curfman here with a March 2021 edition of Matt's Minutes. For those of you that have followed these over the last year, I started actually with this as my background a year ago. March marks the 1 year anniversary of really the pandemic unfolding in the U.S. and March of 2020. Seems like a lifetime ago, but many of you probably recall the incredible market turmoil where we had a window of almost 4 weeks between the end of February and 3-4 weeks into March last year, where the markets dropped 30, 35, 40%, depending on the broad index you were looking at. Fear and uncertainty was unfolding in the U.S. and around the globe. And so I thought I would just change my background because it's now been a year. We're obviously still operating a lot from our home offices. And as everyone got settled into their home offices, backgrounds looked a little different. But at any rate, I just wanted to come and touch base on where we're at with March of 2021, what we think is happening, and then give you some context as we look forward into the remainder of the year. So year to date, you're seeing kind of a mixed response, and it really depends on the day that you look to say, are the markets up? Are they flat? Are they positive? We're starting to see in March a little bit of what I would say is a sector rotation, where historically technology has really led the way as far as growth. Many companies, many businesses, Richmond Brothers included, have depended on some technology in order to continue operating as much as normal as possible through the pandemic and stay in touch with all of you, our clients. And so you actually started to see a month in March where kind of the old brick and mortar sort of businesses from a stock perspective started to shine a little bit of light and turn positive. And you actually saw technology kind of pull back a little bit. That said, we're not concerned that the quote technology trade is over. If anything, it's probably accelerating, and businesses are going to continue to use more and more technology to operate in the new world post-pandemic is our belief. So what else is going on economically? So since our last talk, we've had a second round of stimulus. Whether we agree or don't agree with it, it's happening, and a stimulus to the U.S. economy and to individual consumers is really cash in a lot of people's pocket to either support those who are unemployed or underemployed, to help with rent, to help with other expenses, things of that nature. We have rising GDP, gross domestic product. So as that increases, that just means the total output of goods and services in our country are accelerating. There's been several Federal Reserve meetings where the Federal Reserve has committed to keeping short-term rates really quite low, well through 2021, likely into 2022, and possibly into 2023. So low short-term rates, not to be confused with Treasury rates, which I'll touch on in a minute, really help keep the economy moving forward because money is cheap. Now, for many of you who are savers and in retirement, it creates a challenge because low interest rates hurts savers and benefits borrowers. If you think about mortgage interest rates right now, auto loan rates, things of that nature, they're still really at historic lows, which again stimulates spending and the thought that we can borrow money at really cheap rates. But if you've saved money and you don't have debt or you don't have a large need for debt, it's really hard to keep your money really safe and go try to find a reasonable yield. So that's why we have to continue to be creative, using a lot of different holdings, which may cover your portfolio, but you hear some Guggenheim names, some of the safety nets of fixed equity indexed annuities, whether it's just a 0% floor or whether it's for a future lifetime income stream. Lots of creative solutions we're going to have to keep coming up with rates staying where they are to help solve for the safe side of your portfolio. So not much new there. More and more vaccines seem to be rolling out both in Michigan and around the country. And quite frankly, the more and more people that get vaccinated nationally, from an economic standpoint, the more we'll start to see things slowly start to open back up, which should be a good sign for economic activity. There's been a lot of talk about interest rates and inflation, and it's our view that inflation will remain relatively subdued and relatively low, despite all of the excess spending that we see going on and the federal stimulus and things of that nature. If anything, we've had actually inside of our business with clients an acceleration of the thought process of IRA to Roth conversions. And the reason being is that with another round of stimulus and an already high federal deficit, concern that change in the tax law in future years, maybe as soon as 2022, people are trying to jump and take advantage of what are the current low tax rates now by doing more and more IRA to Roth conversions, choosing to pay the tax now one time, and then that money and any future growth is protected by that Roth umbrella. And so we've had quite an acceleration of that activity within our business for all of you as clients. And then, as far as the K-shaped recovery we've talked about over the last 6 months, it seems like we're starting to shift a little bit. We're less of a K-shaped recovery, and as some of the brick and mortar and maybe more of the components of the Dow Jones Industrial Average start to shine a little bit, which is really a fun factor. Well, you can hear one of my dogs here barking now. Sometimes life with a home office can be a lot of fun with dogs, children, other distractions, but it's part of life as we know it these days. So that was Parker, my golden doodle. He really wanted to be part of the video. Either that or he saw someone walking by on the street and he gets overly excited. Last but not least, I wanted to talk about the 10-year Treasury rate. There's been a lot of talk about interest rates increasing or raising, and really they're talking about the 10-year Treasury rate, not the Federal Reserve short-term rate. If you go back pre-pandemic to January of 2020, the 10-year Treasury rate hovered right around 1.9%. During the unfolding of the pandemic, and really in March of 2020, all the way through even September of 2020, we saw a really choppy 10-year Treasury rate, which was really as low as 0.5%. And 0.5% is a pretty remarkably low number. That basically is the rate that the government would pay you if you bought a 10-year government bond for a decade. And so not many people would sign up for 0.5% for 10 years. Well, this year, all of a sudden, that 0.5% rate is starting to climb back up, and we've seen it reach 1.5%, 1.6%, 1.7% even. And certainly an increase from 0.5% all the way up to 1.6 or 7% is a high increase, but still, we're not quite to the level we were pre-pandemic. And so, we would just kind of caution, reading some of the headlines and be concerned about that turning into immediate inflation or high interest rates are going to cause the technology trade to unwind, all sorts of things. It seems to be a grab for attention at this point. And it's getting pretty clear as we move into the month of April that a 1.6 or 1.7% 10-year Treasury yield is not going to do an incredible amount of harm. Many of you watching this video probably remember back in the 1980s when mortgage rates were 15%, but CDs were 12 or 15%. Back then, the 10-year Treasury was almost 16%. And that is when inflation had gone rampant and quite out of control. So that 16% mark is now 1.6%. So not terribly concerned about inflation or interest rates jumping up. And lastly, we had a lot of great results from our surveys we sent out. We're still compiling those so we can get those through compliance and share those. And a lot of you talked about Risklize. And just a reminder, Risklize, your advisory team, we're going to continue to talk to you about this and use this as a new language. Every single underlying investment has its own risk score on a scale of 1 to 99, 1 being ultra conservative, 99 being ultra aggressive. And we want to basically use this as a language to talk to you to make sure you're comfortable with kind of the lower tolerance and upper tolerance ranges around your portfolio. And so you'll hear more and more about Risklize, and if you have questions on your specific portfolio, we are here for you. Don't hesitate to reach out. Questions at richmondbrothers.com. We are happy to be here and honored to serve you. Thank you so much, and I will be back at the end of this month for our April edition of Matt's Minutes. Make it a great month, and happy spring.